We'll get straight into it. Cool. So we are recording. Thanks again for you guys that are joining us for our 20th ever knowledge drop. Huge number, huge drop. We have the handsome and ever charming Rich McDonald over here, who's going to take it away in a second. But yeah, I just want to take a second to say thank you and go kind of over the ground rules. If this is your first time joining a knowledge drop, basically we'll spend the first half of the time. We got a half an hour here together. We'll spend the first half letting Rich go through his deck and dropping all of his infinite wisdom about the stock market, which he worked in that world for many years. So he's going to try to, he actually asked me, he's like, can I do an hour one? And I was like, they're kind of all half an hour, but like, we got to just keep it nice and tight and just get through what you can. But he's definitely got way more than half an hour or 15 minutes worth of knowledge to drop. So he's going to cover like the most basic and like, get as deep with that stuff as he can in a short amount of time. And then hopefully you guys will have some questions for him at the end of all of that. So if questions come up for you while we're going through Rich's deck, feel free to use the question and answer box. If you just want to chat to each other and, agree with me about how charming Rich is and how much you love his accent, feel free to use the chat box for those such comments. But otherwise, yeah, this whole thing's getting recorded, as I mentioned. So this will be in the Knowledge Drop archive later on this week. And you guys can share this with anybody that you think might benefit from it or to watch it again and get some more deeper understanding of the stock market if that's a world that you're trying to play around in. So with all that said, Rich, man, it's the stage is yours. Take it away. And thanks again for doing this, buddy.
Right. Let's try and get this bit right. So we got the share screen.
First step. Nailed it.
Is that me good? Good. Right, guys, let's get into it. So,
wait, it's still not showing your screen share. Sorry.
Oh. Well, so when you said nailed it, we were close.
The first, yeah, you nailed what the first step is, but it didn't quite happen.
Right, so there we go, desktop and share screen.
There you go. Now we're in there. Amazing, man.
And we're off and running. Okay, guys, so as Travis said, this is there's a lot to get through, so buckle up. We're going to go pretty quick. What's about to drop? Looking to demystify the market for you. If you look down at the bottom there, the chart, the stock market, it's such a fun game. And it's not just for the guys in the skyscrapers and the fancy suits. If there's one thing that I learned from traveling with Veritas is how much you Americans like your weed. That's right, your marijuana. So the graph down at the bottom there is a company called Canopy Growth. Now, in the last 3 months, the share price in this company has doubled. And for various reasons, Constellation Brands took a stake. But literally, this took like 4 or 5 days for the guys in the skyscrapers to get their head around what was actually going on. Whereas, I was chatting to people in Veritas and they're saying, this is great. This is a huge deal. So, that's the kind of thing you can make money in from whatever your knowledge is, from whatever your background is. There's something that you can use that for. So, don't think that it's not for you. We're going to move on to how to look beyond the share price or the size of a company, because it doesn't really mean anything. Hopefully by the end of this, you'll have a better idea what to look at, and whether you're at a dinner party or you're looking to actually invest, you'll know more about what you're talking about when it comes to valuations. And then finally, we're going to look at the mistakes that I've made. That could be a knowledge drop in itself over the past 15 years, and hopefully you won't make them as well. Why Travis has asked me to come along today. So I was a hedge fund manager for one of Europe's biggest hedge funds during the financial crisis. So a great place to kind of learn my education. I then moved on becoming head of Equities Trading and a director for Credit Suisse. And that was across Europe and Africa. And if I built up any credibility, then that's me shooting it down right there. That was my last day in Johannesburg trading floor. When they begged me to wear my national dress. You can see the trading screens in the background there. It gives you an idea of how much information that we were taking in sort of all day, every day. And I love the job, love the actual markets themselves. The people aren't very nice. When people say that, bankers rhymes with something else, then generally they are correct. So I wanted to get out of the game. But still continue to do the job. So now I run a hobby fund, I'd like to call it. So a mini hedge fund I run, working remotely and using everything that remote year has the chance to travel at the same time. So let's get into it. Apologies, if any of you guys know this already. I just want to get through the absolute basics if we do have beginners on the call. Is it a stock market or a market of stocks? When people talk about indices, you hear the Dow Jones, the S&P, NASDAQ, Nikkei, so all the world's different stock indexes, indices, then from around the world. They're generally made up of each industry. So you look at the energy industry with oil names, the financials, pharmaceuticals, the retailers. That's how you usually see them reported in newspapers and on the television. But what does that mean? Well, some funds look on a macro level. So if you studied economics, then you might be an expert in inflation, unemployment, how Trump being elected affected the future of the economy, and that's very much a macro top-down view. At the same time, you could know a company very well. Maybe you work for a Groupon or a General Electric or Facebook. So then from the micro level, bottom up, that's called, about a company, about its growth prospects. The best chance that you've got is you put those two together. You've got an economics degree, and Canopy Growth or a Snapchat, or specific things about companies themselves. Okay, so what are you actually buying when you invest into a company? If I buy a stock, then I'm buying the future profit streams of that company. So on the right-hand side, you see the graph. I need to know the expectations I have for the company to make. Let's take Verizon, for example. What do I know about Verizon profits? They're going to make in year 1, year 2, year 3, and the future. I take all those profit streams and then I bring them back to a value today, and that gives me an idea of what I'm prepared to pay for it. Okay. Something like Verizon, you would expect the management there to have a real idea about how many subscribers they've got. They can't put prices up by that much. People will just flip to a T-Mobile. So you've got a real good idea of what their profits are going to be in 2 years' time, 4 years' time. And then that means that the stock isn't going to be very volatile. It also means that that company has paid a lot of its capital expenditure for building infrastructure. A lot of that's been paid already, and it can focus on handing the money back to you. It does this in the form of a dividend. So if I buy a stock in Verizon today, I know I'm going to get, say, a 5% dividend in a year's time, another 5% dividend in year 2 and year 3, for example. So it's a very steady earning stream. That's great for somebody who's maybe about to come to retirement. If they put their money in the bank, they're going to get a 1% return. If they put their money into Verizon, they're going to get a 5% return. And if they put their money into Argentinian debt, give it to the government here, they're going to get a 20% return. But, you never know whether you're actually going to be able to get your capital back. On the other side of the scale, there's a company that you don't really have any idea what the true profits are going to be in 4 years' time. Let's take Netflix. Netflix announced what they think their subscribers are going to be for the next quarter when they're already a third of the way through the quarter. So I only know what Netflix think that, the December number, let's say the last quarter, I think Netflix had 150 million subscribers. They're telling me that by December, they're going to have 156 million subscribers. But, what if Stranger Things 2 isn't too great? What if the whole Kevin Spacey thing came to a head and, people aren't happy watching House of Cards from then on? So, the volatility around a stock like Netflix is far greater than a Verizon. So, and at the moment, Netflix doesn't make any profits because it's still trying to grow these subscribers. So it's two very differences in the how attractive a stock like Netflix or a stock like Verizon is. Verizon's a lot safer. It's going to pay you a good earnings stream. However, Netflix is up 60% this year alone. So if you put $100 into Netflix on January the 1st, your stake is now worth 160. If you put $100 into Verizon on January the 1st, then you're probably sitting around 105 at the moment. So it's it's very much dependent on your risk, how willing you are to take the risk on your capital investment in the first place. Okay, so then let's go on to the difference between the share price, the market cap, and the valuation, right? A share price means absolutely nothing. Netflix trades around $200 a share. Apple trades around $200 a share. Doesn't mean anything. They both got very different number of shares in the company. And they both got very different growth prospects. So then we go on, okay, so if the share price doesn't tell us anything, then maybe the market cap tells us something. Market cap is the share price multiplied by the number of shares outstanding. So that gives you the total size of the company. So Apple's worth $900 billion in that case. Right, that tells me a little bit more. But it doesn't tell me whether I should invest in it compared to whether I should invest in a Netflix or whether I should invest in an Amazon. The only way that I know and I can compare the three of them is by looking at the valuation, right? So today we're going to go through the most simple valuation metric of them all, but also the most commonly used. Something like a retailer or a restaurant chain such as McDonald's, you'll look at the price earnings ratio. And that is simply, and believe me, this is far simpler than it looks, okay? It's just the share price divided by the earnings per share. So you don't have to worry about how many shares are in the company. You don't have to worry about the size of the company. All you're taking is today's share price and the EPS, earnings per share, which is, in most newspapers, you can find it online. It's a fairly easy number to get. Now, that equation gives us our PE multiple, price earnings multiple. And the way you won't really get this explanation in a textbook, but the way that I like to and have taught many graduates in the past is look at the PE multiple as the company coming to you and saying, right, this is, if you give me your money today, this is how long it will take for me to pay you back, right? So just as if one of the Veritas guys wants to borrow money from me, I say, well, when am I getting my money back? Because it's fairly risky giving money to you. And you know who I've got in mind when you're saying this, all the Veritans that are watching. Right, so share price divided by earnings per share gives you your PE multiple. When a company comes to market in the first place, such as the Snapchat IPO, the management are looking to everybody and saying, right, we will pay you back into the profit that we are making today, right? Giving us $1 today, we'll pay you back that money in 60 years' time, right? So the PE multiple, you can look at number of years it's going to take the company to pay you back. Now let's go into the example here. So McDonald's trades $18 a share, so that's our top line, and it makes $1 profit. That's our earnings per share. So $18 divided by $1 per share profit gives us a multiple of 18 times. If I buy a McDonald's share today, at today's profits, it's going to take me 18 years for them to pay me the money back. And that's in the form of dividends. Okay? So McDonald's pays me back $1 a year. At the end of the 18 years, I've got my $18 back. Okay? So let's look at Five Guys. Right? Now, let's pretend Five Guys is coming to market in an IPO, an initial public offering. And they're coming to you and they're saying, right, we want to sell our shares at $18 as well. But we only make 72 cents profit, right? Now you look at that and you think, well, McDonald's is making more profit than you and they're charging the same for one share in the company. So why should I pay $18 for a Five Guys share when I can get more profit from McDonald's? So essentially what the Five Guys management are telling you is it will take us 25 years to pay you back your money, whereas McDonald's can pay you back in 18 years. So, and this is where the the price earnings ratio helps you understand the difference between the two companies, because Five Guys management are saying that because they're growing at 30% a year. They're opening more restaurants, the burgers are better, and the management are very aggressive. So they demand a higher multiple, right? They demand a higher multiple because they are the seller. So if we go into the numbers, then at today's numbers, McDonald's 2017 earnings multiple is 18.2 times, right? 18.2 times. Five Guys is 25 times. So that's what we took. So 2017, you'll see in the table at the bottom, the PE multiple that McDonald's is trading at is 18.2, and at Five Guys, it's 25 times. However, because Five Guys is growing far quicker, the profits are jumping at a much higher rate than McDonald's are. In 2018, the difference goes to 16.4 times, right? So the way we get that is the share price is still $18, but the earnings per share for McDonald's in 2018 has moved up 10%. So they're making $1.10 now. Okay, so $18 divided by 16.4, sorry, $18 divided by $1.10 is now 16.4. So the PE multiple comes down over time. As the profits grow and the share price stays the same, the earnings multiple, the PE multiple, drops. Of course, Five Guys multiple is dropping at a far quicker rate because it's growing profits at 30% a year. Okay, that's how you compare two different companies, especially in the same sector. I can compare two different companies in the same sector by looking out to the PE multiple from 2019, so 2 years or 3 years ahead, and see that both McDonald's and Five Guys are trading on 14.7 times earnings, or they're saying to me, Rich, we'll pay you back in 14.7 years, okay, nearly 15 years, we'll both pay you back. However, Five Guys might still be growing at 20% growth, and McDonald's is still at 10%. So the Five Guys share price, to reflect this, in 2019 will have grown at a quicker rate than the McDonald's share price. Okay, now just to test everybody to see if we're following at that point, think on your own experience on Nike and Adidas and go back 2 years. Nike and Adidas were both trading at 64. Okay, Nike and Adidas, their share price was 64. Think about what you've seen in the shops, and whether your friends have started wearing more Nike, more Adidas. Which stock do you think you would have made most money on in the last 2 years? So answers into the chat box, and Travis is going to keep a hold of that.
Chat some answers in here.
Okay. Right.
What do you guys vote? Okay, here we go. Got a couple coming in.
Yeah, let's keep those coming in. So what happens when it goes wrong, right? We know the PE multiple. The PE multiple is when McDonald's says, we're going to pay you back in 18 years. Five Guys says, we're going to pay you back in 25 years, and you're happy to pay that price. When it goes wrong, okay, and this is not me in the picture, it's one of my colleagues. What if there's a scare to the industry or the economy, right? Let's stick with beef. What happens if there's mad cow disease? Right? Everybody panics. The stock price drops through the floor. Mad cow disease. Am I going to go to McDonald's? No, I'm going to go to KFC. Well, I'm going to go to KFC and get a chicken burger instead of a beef burger. Or, maybe even simpler than that, vegetarianism really starts to take a hold and gets more and more popular. People are more concerned about their health, as has happened over the past 10 years. So there's concerns to the McDonald's menu, and So let's look. If the mad cow disease hit, there's a cut in earnings, right? They're going to make 10 cents less than they were predicted to make before. But also now the buyers are in control, right? When there's panic happening, the buyers are in control because the sellers want to get out of the stock, and the buyers can set the terms of the deal. So now they say, I don't want to be paid back in 25 years. I don't trust you as much now. Pay me back in 23 years. Okay, that's the only price I'm prepared to pay. So I take the earnings estimate down, okay, from 72 cents to 62 cents, right? The math's in the bottom right-hand corner if you want to go through the math. So I'm not going to earn 72 cents anymore that we promised at the IPO, right? 72 cents profit. Now we're going to earn 62 cents. And I'm cutting the multiple down by 10%. So 25 times to 22.5. Sorry, it says 23, I mean 22.5. So 22.5 multiplied by 62 cents is now a share price of $13.95, right? So that stock's fallen from $18 to under $14 because of a scare in the industry. Now, if you run through the math yourself after the presentation's done, you'll see McDonald's doesn't drop nearly as much. And that's because McDonald's was on a smaller earnings multiple to start with. And now so it's regarded as safer. And that's the problem with something trading at high multiple, like a Netflix, an Amazon, a Tesla, is that there's huge belief in these companies that they're going to grow at a much faster rate. But if you look at the PE ratio, you can tell whether you're being asked to pay far too high a price for the belief that a Netflix, that an Amazon is going to make profits in the future. If it's a Verizon, you know they're going to make profits in the future, and they're not really asking you to pay that expensive a price for the stock. If it's a high multiple, you have to be certain that the company is going to keep growing at such a fast rate. Now, it doesn't just apply to companies, right? It can apply to the whole index. So the S&P 500, the 500 biggest companies in the US that are quoted on the stock market, is trading at 25.75 at the moment, right? S&P 500, 25.75. You get that in your newspaper tomorrow. It's on an earnings multiple, a PE of 18 times earnings, right? So they add up all the profits of those 500 companies and they divide it by the number of shares in those 500 companies. And the profits, the EPS of the whole index is $143, right? So your $143 multiplied by 18 times earnings is $25.75. So at the moment, the whole city is talking about tax reform, right? It's the only thing that matters, because the tax reform benefit is an additional $10 profit on top of the 143 already, okay? So $10 profit on the $143 that all the 500 companies make at the moment. And of course, you multiply that 10 by 18 because it's on 18 times earnings. So it's an extra 180 points. So if tax reform passed tomorrow, the S&P 500 would go up by 180 points. And it's as simple as that. I know it's hard to get your head around, but you know, if you want to go back over the slides or ask me questions in the future, then you know, I'm very happy to try and explain further. Right, 5 keys to success. So as we said, invest in what you know. So if you know weed, invest in weed. If you are a web developer, then you know all about the cloud, then have a look at Microsoft and Intel, if it's as simple as, I'd never heard of Venmo before I joined Remote Year, and every day somebody goes, "Oh, Venmo you," or "I'll Venmo you. Can you Venmo me?" Investing in PayPal a year ago, or even 6 months ago when we started Remote Year, PayPal owned Venmo, I believe, then that stock's gone up 50%. So if you thought Venmo was a good idea, invest in Venmo. Invest in what you know. There's a movie called Margin Call, and Jeremy Irons does a great speech in it. And he says, to win at this game, you have to be faster, you have to be cleverer, or cheat. I'm not in the game of cheating, and I'm definitely not clever. So basically, be faster. And there was a great example of this. I wish we had been online a few hours ago, because Snapchat had a disaster last night on earnings. It was down 20%. So this morning I opened up my trading system, Snapchat trading down 20% still. And then suddenly there was an announcement that Tencent, the huge Chinese company, had bought a 10% stake in Snapchat. The stock, I was very lucky. I'd seen it. I saw it hit the tapes. I had my trading system open, so I was able to buy some Snapchat at $12.25. And within 10 minutes, it was trading at $13. 20 minutes, it was trading at $14, and it got all the way up to $15. So yeah, sitting in front of the screen or getting information quickly, is a great way to do it. However, if this is, if it's not your business, then being cleverer can mean simply being, all of you that are in web design, that maybe work in industries like digital marketing, or other such industries where you're going to know and be an expert in that field, because the analysts and the portfolio managers do not know as much as you about an industry. Traveling on remote year, I've learned about Venmo, I've learned about wheat, and just chatting to people around you, you have a far greater insight than the guy stuck up in the skyscrapers in New York or London. Right, sizing and timing. Being wrong when you're actually right. If you go too early, or as anything in life, if you go too big too early, then that can be a problem. And taking a too big position before the story actually breaks, then you're going to be wrong, and you're going to lose too much money. You're going to have to sell the position before it actually comes right. Do your research, very important.
Rich, not to interrupt, but just speaking of being faster, we're actually at time. So I mean, as fast as we can wrap up and hopefully get
right. Control your greed, very important. And this graph here is one to watch at, just in case you're jumping in at the wrong level. Right, surefire ways to lose. The guy in the bottom right-hand corner, I'm sure you guys recognize him. He was pumping penny shares. Don't touch penny shares; they're disasters. Don't go with tips and rumors. 90% of them are wrong. Risk reward, right? If you toss a coin to make an investment decision, you'd hit 50-50. The good guys hit 65%. So don't trade with an ego. You're going to be wrong. Just try and be right more often than you're wrong. And also, you want to control when something starts going wrong, cut it quick. When it starts going right, then you ride that for as long as possible. However, nobody ever went broke taking a profit. The Snapchat example earlier this morning traded up to $15, and now it's back down to under 14. So, it's important to take a profit. Nobody ever went broke that way. If you're enjoying the adrenaline rush and valuing that more important than making money, then get out, go to the casino, because overtrading can be a killer. And at the same time, under trading, if you want to do the analysis and you focus too much on running numbers for months before you make a trade, that can also be the way to not make any money. Okay, homework. That's a great link on how the economy works. Ray Dalio is very entertaining as well. Watch movies. Wall Street, The Big Short is especially good, and the one I mentioned, Margin Call. Stay tuned. Myself and Nick Tyrrell on Veritas are trying to do video more of these kind of things, and at much greater length. We will hopefully have between 5 and 10 hours of tutorials by the end of remote year, and also calling on all web developers on that. If you'd like to be involved, eventually we'd like to have our own website where we can talk like this. We can be online about a Snapchat earnings, and we can discuss ideas, etc., etc. So web developers, if you're interested in that, please get in touch. And if you have any other questions, then please email me, Slack me. The odd Instagram picture can be quite entertaining. And thank you very much.
Woo! Crowd goes wild. Awesome, man. Yeah, if you want to jump on a screen share. I don't know if anybody has a question. We're kind of at time. I might just say thank you and thanks to everybody for joining us, and just tell people you guys can find Rich McDonald on Slack if you want to dig a little deeper with some of this and ask him some questions as follow-up. But thanks for trying to get through this as fast as you could, man. I know it's a lot of content to try to cover as quick as you can. But I think you did a really incredible job. I feel like I know the stock market better than I ever have in my whole life. So thanks again. Thank you guys for joining us. And you can find this recording in the archive later on this week. So cheers. Oh, also on the story of Adidas and Nike, we had 2 votes for each. If you want to wrap up really quick by just telling us what the outcome of that was.
Sure. So Adidas, you might have seen your friends, really start to wear a lot more Adidas. The stock is now trading at 190 and Nike's at 54. So that can show you the difference, if a company gets it right and the expectations are a little bit too low. Adidas, 300% return your money, and Nike would have lost money. Any questions at all, please feel free to Slack me. Apologies that we ran over. And yeah, very keen to hear any thoughts or questions you have. Thank you.
Awesome.
And thanks, Travis.
Thanks again, guys. We'll see you back here 2 weeks' time. Have a great night.